PB, and to also make sure that the advice that was given by a tax practitioner or anyone who provided any type of tax advice was uniform, that they all had the same type of qualifications or had experience or something like that. It included accountants and anyone who did tax at that point in 2009, and now financial advisors have been brought under it as well. Sasha.
Yeah. What was the previous slide again?
This one? Yeah. PI, Professional Indemnity Cover. Sorry, this one as well. Oh, sorry, yes. So if you make a claim, or say there's a complaint against you as the advisor, let's say it goes to FOSS or the client comes to you directly, we have PI cover that covers you for financial product advice. It's called Professional Indemnity Cover. So we have that now and ongoing as well. So if you decide to leave us and join another licensee or fully retire, it'll cover you into perpetuity for that particular type of advice provided while you were only with us. Yeah? If you have to make a claim, so let's say there's been a complaint against you and you need to make a claim for financial planning cover, let's say it goes to FOSS or the courts or something like that and the client wants some sort of monetary payment. If it's to do with financial planning advice, we ask that the advisor pay $7,500 for financial planning. And if it's related to margin lending, the excess is higher at 75% of our excess, which is $50,000. Straightforward. Sorry, back to TASA. So John sent out an email about 2 weeks ago about TASA. There's nothing really you have to do, but please use that disclaimer that's in the email. It has to be on every SOA that you use until we tell you to stop. It is up to us to actually register you. We have roughly around 320 advisors, and it is taking a little while to do. If you have changed anything, you have changed your phone number, email address, business address, postal address, please let us know. This is the type of information that we have to give the TPB on your behalf. Okay. There is no training requirement yet. There may be training requirements at re-registration. There was a draft sort of policy released a couple of weeks ago, but it hasn't actually passed as yet. So at this point in time, there's no extra training requirements.
Rose,
Yes?
does it make a difference if you have a diploma or advanced diploma?
Not as yet, no. Sorry, is there a difference if you have a diploma or a degree or something like that? It hasn't been put into effect as yet, so not as yet. They do talk about when we have to re-register you in about 2 to 3 years' time. So there's a registration period of about 18 months. And we'll sort of do that in the next couple of weeks and finalise all of that for you. But after the re-registration, if you were to register for the first time, there will be additional requirements for you. So if you have a son or a daughter or a friend, there'll be additional degree or diploma requirements for you. It hasn't been confirmed as yet. And then when you re-register as an advisor, or we do it on your behalf, there will be some training requirements. We don't know 100% as yet. There's talk of being part of, for example, the AFA or the CPA, the FPA, and having perhaps a diploma and then 6 years worth of experience or 8 years worth of experience if you don't have some of that.
Because ADFS has already covered tax planning.
Yes, that's it. So if you have done the Advanced Diploma of Financial Planning, it has a taxation planning unit, but the TPB also talked about doing commercial law subjects as well. So if you have a degree, like say in commerce, for example, you might find that if you've done that commercial law subject, you may be covered. But we don't know as yet. I mean, Kaplan sort of does have a knowledge area called taxation. Whether or not that is something that we can use, we're not 100% sure. Okay. Post-appointment letters. The use of a post-appointment letter is compulsory for Synchron advisors who provide insurance advice. It is really, really important. It includes the duty of disclosure disclaimer, which is not in any of our SOAs. And I know a lot of you guys poo-poo this, but it has been found to work. Okay? We have found that in complaints, for FOSS stuff, it has really made a bit of a big difference. You should all have that. If you don't have the templates, please come and see me. Risk profiling. So this is a lot for investment guys. You'll notice that in the SOA, there's something like 6 pages of profiles, balanced growth, high growth, that sort of thing. Please take out what is not appropriate to the client. Please don't create your own risk profiles. Please come and see us first. The risk profiles that we have given you have been backed up by the research that we have completed, and we find that that's a good conservative understanding of risk profiling. If you want to change it for whatever reason, let's say you think growth is too conservative or high growth should be a growth, talk to us. We're happy to talk to you about it. We want to make sure that you have a basis of advice on the risk profiling that you're doing. Another important thing is, so here's an example of a balanced risk profile. Another important thing we're finding is you might recommend a client have a balanced risk profile because you've done the questionnaire, but suddenly you're recommending 100% property. Clearly that's outside the balanced risk profile. You need to explain why. Okay. So we have had complaints where advisors have recommended a particular risk profile, but their investments are completely out, and that is something that will be brought up to us as a complaint through FOSS, for example. So I usually recommend if there's a 5 or 10% difference in the risk profile itself, let's say in this case 100% property, please say why. Maybe the client was really interested in property, has always wanted to own an investment property, came to see you specifically for this reason. You need to justify.
Can we recommend a strategy?
Sorry?
Can we recommend a strategy?
Yes, you can still recommend the strategy, but you need to have a backing of why you've done it. So again, this goes back to why has a client come to see me in the first place? What are your primary goals and objectives? Yeah? Jeff?
Where a client's risk profile might in actual fact come out as, let's say, balanced, but they decide that they want to be more assertive.
Yeah.
How do you...
Yeah, great. So what you would do is have that conversation with the client, and you might, bring out the profiles themselves, and you might say, look, here's an example of a balanced portfolio, and here's an example of the one up, which is a growth portfolio. You'll see how they're different. And then see if the client is comfortable moving into the next portfolio, which is a growth. So they might fill out that questionnaire and it might come out as a balanced, but after conversations with them, they might actually be a growth portfolio. And that's perfectly okay. Pop it in that risk questionnaire and pop it in your SOA that you've had that discussion with them.
You just get them to sign off on the bottom of the
Yeah.
profile.
Yeah.
I want to be more assertive.
Exactly. And then what you would write as well is, so our page usually has this graph and then this table, and it's got a little bit of wording on top. What I would recommend is under everything, you write something like, Mr. Smith, we've had a bit of a discussion. Initially, you were a balanced risk profile, but after discussions with us, and you might have talked about certain things as well, and we brought up this, we brought up that, we've come to the understanding that you're actually a growth risk profile. If this changes or if you're not comfortable with this, please contact me as soon as possible. Something along those lines. Okay.
Oops.
Yes?
What qualification we need to recommend direct equities?
So this is a direct equities question. If you're interested in providing securities advice and you're not authorised for it, we need to see that you've done some sort of course in it. So if you've done your DFP through Kaplan, for example, it's usually covered under the investment planning 1 component of it, but we need something from you to show that you've done that. A certificate from Kaplan, what is it called? The statement of attainment from Kaplan as well. And then we'll ask you a couple of securities questions to back that up.
So someone has done ADFS.
You will be covered, yeah, but we'll need something from you from that, okay? And it's the same for everything. If you decide you are an investment planning guy, but you want to include SMSF, yes, we will increase your authority for that, but we want to see that you've done a course for it or you're able to provide enough relevant experience in it. We will ask you questions, and we would just want you to give it a go and answer that and have that discussion with us.
My billing Synchron covers ASX 200.
300. Top 300 ASX. Yeah. We don't have authority to provide derivative advice, property advice, mortgage broking, or anything like that. Our highest level of advice is usually SMSF or securities and NDAs, but we don't give that out.
Using the put options.
Now, talk to me about that a little bit later because we don't actually have that, but we're willing to look at some stuff if you've got anything. I think that's it. So just want to finish that last bit off by saying, yes, we cover the underlying products on our APL. If you find a product that you really love for whatever reason, or the client has come to see you with it and really wants to use this particular product, and it's not on our APL, please speak to us. We require the product's name, APIR code, research reports, Lonsec, Zenith, whatever, PDS, and any supporting material that you might have. We'll also might ask you if it's, for example, just an approved product. Yes, it's an approved product by a research house. Why is it that you want to use it? And we'll have that discussion with you. Remember, if it is not on our underlying APL, you will not be covered at all by PI. A couple of legislative changes. So this is really important for anyone who provides insurance advice, specifically insurance advice within super. So there have been a lot of changes. This is the SIS Act changes, Superannuation Industry Supervision Act. So the definition of incapacity has changed. Own occupation is no longer allowed after the 1st of July 2014. So if you have existing clients who have insurance within super, all of their policies will be grandfathered. If you decide to change them, let's say they've got TPD through super and it changes, you might want to rewrite their policies for whatever reason or change them into a better policy. Please keep in mind that there will be changes. Their own occupation will no longer be covered, and the any occupation change is now different as well. So previously it used to be or. It is now and for own occupation. Sorry, any occupation. Yeah? So even the any occupation definition has changed. A couple of other things. So additional criteria will apply for claims. So that's what I was talking about just before. Any occupation definition has changed as well. It'll now be and not just ors. And trauma will no longer be covered. So the idea is that trustees of superannuation funds, Colonial First State, AMP, whatever, are no longer able to offer clients anything that contravenes this. If it doesn't meet a condition of release, it can no longer be provided to the client. Please also keep this in mind if you provide SMSF advice and insurance within SMSF. As the trustees, they are no longer able to actually get insurance within SMSF if it doesn't cover a condition of release. If you're unsure what that is, please come and see me.
Sorry, that's just a quick question. For example, a 55 or a 60-year-old person could take trauma out of their self-managed super fund?
Not anymore, no. That's not available anymore at all. Okay.
Because that doesn't satisfy sole purpose case.
Sole purpose and no condition of release. There's a specific thing in the actual legislation where TPD has been able to come around that, but not trauma. Okay. Income protection changes as well. So you are no longer able to the client is no longer able to receive a lump sum income protection benefit. It has to be paid out similar to what a pension is being paid out if it is taken through super. Remember, older policies are grandfathered, but newer ones have changed. And a member will not be eligible for temporary incapacity if they receive sick leave benefits as well. So it's really important, please remember this, if you are switching, changing, creating a new policy. The old policies are incredibly vital at the moment. And look, if it doesn't meet the client's needs or it's no longer relevant to them, great, change it. But please keep in mind that they will no longer have those type of benefits that they had before. Okay. Insurance Contracts Act changes. So 3-year innocent non-disclosure period is still relevant. But what they've said now is if there is innocent non-disclosure, the insurance company now has the ability to actually either completely void the product or take into account that change and amend the policy itself. So they weren't previously able to amend the policy and to take into account that change, but now they can. So you might be able to say, client didn't tell me about this, I'm so sorry, can we talk about this? Can we see if there's anything we can do to keep that policy, but just take into account that. But please remember the 3-year innocent non-disclosure still applies, and we are of the opinion that perhaps that change will cause the 3-year innocent non-disclosure period to start again. Fee disclosure statements. What is a fee disclosure statement or an FDS? So it's an annual statement that you send out to a client. It just tells them what the fees are, tells them what services they were supposed to receive and what services they actually did receive. It's now. Please start doing it now. If you don't know what you're doing, please come and speak to me as soon as possible. We do have templates and we do have stuff that can help you out. What is not included? A payment plan for an upfront fee. So if I came to see you as a client, you might say, Rose, that's $3,000, and I might say, can't really afford that. Can I pay that over 12 months, $100 every couple of weeks? That is not an ongoing fee. That is me trying to pay out an upfront payment. So you don't have to do an FDS for that. Fee that is insurance premiums. If you do pure risk and you only get those insurance commissions, it doesn't include FDSs. It's just not included at all. If you receive some sort of additional benefit on top of that, let's say through a super account, then it may be covered. No product trailing commissions, inbuilt fees into the product, not included in FDSs. If you have dialed it up in any way, or if you have added an additional fee on top of that, it will most likely be covered. You will need to do an FDS. Okay? And nothing that is a product fee. It is now, and I'm sorry, it has changed in the last couple of weeks or so, this bottom part, it does only include new clients as of the 1st of July 2013. If you have existing clients, you don't have to do it. If you're already doing it and you have everything set up and you feel that it is adding value to your business, you can continue to do it for existing clients, but it is only mandatory for new clients as of the 1st of July 2013. Remember, you don't need anything back from the client. It's perfectly okay to email it out to them, mail it out to them, add a covering letter. You don't need them to pay you anything more or anything less. You don't need to explain yourself to them if that's something that you don't want to do. Okay.
What about opt-in?
Opt-in, from what we understand, has been removed. So that was that 2-year opt-in. Every 2 years you need to get them to sign a new sort of ongoing fee payment with you. From what we understand, that's been removed.
The fee disclosure statements are annual, aren't they?
Yes.
So even if you had a client that went back prior to 1 July 13, you still have to deal with, you still have to give them the fee. So every client needs a fee disclosure statement now.
So it's what we've taken, well, it's not us now. It has actually changed to only new clients as of the 1st of July 2013. So you might have an existing client that you saw in 2000, you might have started some sort of superannuation account for them then. That hasn't changed. You haven't sort of changed them into a new product from the 1st of July 2013. You don't need to do an FDS with them. If you, no, and not ever. If you have, for whatever reason, done it before, wanting to continue it, that's okay. If you decide to move them into a new product, not a super to pension transfer, but completely new product, then you will have to do an FDS going forward. You can, say for administration reasons, preempt all those disclosure dates. Do them now. You've got about 30 to 60 days. We've heard talks it's now moved to 60 days to actually get that FDS out to the client. And maybe you want to do that across clients. If you have clients that you might have seen in December and it hasn't even been a year yet, that's perfectly okay. You can batch them today and just send them out. And then every year you know that today is the day that you have to do it. It's only once a year. Alternatively, you can set a disclosure date for each of those clients separately, and that'll depend on that particular client when they entered into that fee arrangement with you. And then you can do it as it comes up. Okay? It's just important to do
I
it.
think the best practice is after 1st July, just do for all the clients.
Yeah, a lot of advisors are doing that. A lot of advisors are batching it and doing it as soon as possible. Synchron Duty of Disclosure video. So this is a new video that our lovely chairman Michael Harrison has put together for you. It is available on the Synchron website, and it is also available in the advisor section of the Synchron website. We've seen a lot of advisors using this in different ways, sending it as an email to their client, you know, having a little bit of a chat and playing it to them on their iPads. It's a really good reinforcement of the duty of disclosure and does cover the 3-year innocent non-disclosure period. Okay. It isn't mandatory yet, so we sort of leave it up to your discretion, but we might make it mandatory going forward. Here it is.
Congratulations on your decision to purchase a life insurance policy. Policies covering life, income protection and trauma provide you and your family with valuable protection, so it's important to make sure that a claim will be paid as quickly as possible. For that reason, it's essential to understand that under the Insurance Contracts Act, you must tell the insurer anything that might be relevant to their decision whether or not to offer you insurance. In practical terms, this means you must outline details of doctor's visits, accidents or previous illnesses that should be taken into account. Even if a medical condition has been resolved or is being properly managed, or there are no obvious injuries that are the result of an accident, you should note them on your application. This also applies if you have a doctor's appointment after you sign your application but before the policy is issued. Whilst this might affect the premiums, it's better than taking the risk that a claim may not be paid due to non-disclosure. If you're not sure about whether something is important, you should always disclose it, because insurers will check your medical history if you have a claim. Of course, if you become ill or have an accident after the policy has been issued, you'll be fully covered. That's the reason for having insurance. If you have any questions, please ask your advisor.
Okay, so again, available on the Synchron website for you to use. A couple of frequently asked questions before I'm kicked off. When do you provide an SOA? You provide an SOA anytime you provide any type of financial advice to the client. We do not have execution-only documents, so we ask that you provide an SOA, even if it is a simple basic SOA to the client. When do you provide an ROA, which is a record of advice? You'll notice in the front of our ROA template there is a checklist. Please use that. So basically, there haven't been any significant changes previously to the client. There has been an SOA previously as well. Okay, so you might do, let's say, switching of a product, or you might do a slight increase in insurance, something like that. I think that's sort of it. Thank you so much for listening. A couple of final plugs. Please listen to Annie Marshall's section next. It is really, really informative and really good and ties back into some of the things that I've actually talked about. Synchron has a risk comparator on our website that it's free and available for you to use right now. So if you don't have any type of software that you're using, you're welcome to use that. That's it. Thank you very much.